There are two ways to make money on Wall Street. The first is to spend 20 years climbing the corporate ladder, wearing Patagonia vests, and slowly building your client list. The second is to sit in a converted garden shed with a laptop, hooked up to dial-up internet, and systematically bet against the smartest guys in the room. Jamie Ma and Charlie Ledley chose the shed. With 110 grand and zero institutional respect, they pulled off what is arguably the greatest asymmetrical trade in finance history. This is the story of Cornwall Capital, or as they are more known in pop culture thanks to The Big Short, Brownfield Capital. Jamie and Charlie were born at a very young age. They went to school, but not for finance. Jamie was a history major, and Charlie's big Wall Street credential was being a glorified spreadsheet intern at a private equity shop. It's the finance equivalent of being assistant regional manager.
Assistant to the sensei, that's pretty cool.
Assistant sensei.
Okay.
They managed to save up some money and start a fund with 110 grand, working out of a converted garden shed. Now, in the spirit of full transparency, and as opposed to what the movie would have you believe, the 110k Jamie and Charlie started with came partly from Jamie's dad, who ran an actual private equity firm. So if you were hoping for a pure David versus Wall Street story, there's a small Nippo baby asterisk there. I guess every hero's journey needs hard work, dedication, and a small six-figure investment from your rich dad. Here's the entire thesis of their garden hedge fund, or should I say, shed fund. They scoured the market for mispriced options where the downside was capped at a very reasonable amount, but the upside was a life-changing payout. This is what we call an asymmetric bet. So yeah, these were the generous just like you and me. The only difference is that they actually read SEC filings before YOLOing their money on risky and liquid derivatives. The first real big break came from Capital One. Capital One was the credit card and banking giant behind about 3 decades of what's in your wallet ads. One of the biggest consumer lenders in the country. Not long after they opened the fund, the stock got chopped in half on rumors of a regulatory dispute and whispers of fraud. Every institutional fund manager with a Bloomberg terminal panic sold on the headline alone. But Jamie and Charlie did what nobody else apparently had time for. They looked. They called former employees. They checked whether Capital One's executives were buying or selling shares during the panic. Because committing corporate fraud while aggressively buying your own crime scene stock is a genuinely regarded strategy. Jamie and Charlie saw that the company was sound and that the execs were buying the dip in bulk, and concluded that the fraud story was pure noise while the market had priced the company for bankruptcy. But instead of buying the beaten down shares outright, they dropped $26,000 into leaps, betting the stock would recover well before those contracts expired. But what the hell is a LEAPS, you may ask? A LEAPS stands for Long-Term Equity Anticipation Security. And to be honest, it's just pretentious Wall Street douchebag lingo for a long-dated option contract. I can imagine somewhere in a bar there's a finance bro bragging about coming up with this shitty acronym. So what it simply is, an option contract dated a year or more. This must be shocking news to you if you're coming from Wall Street bets and have only seen 0 DTEs and the occasional weekly. The advantage of a LEAPS is that it doesn't expire for at least 1 year. So as opposed to your typical short-dated options that are Theta Gang's favorite snack, a LEAPS gives your thesis room to breathe. But that assumes you had a thesis to begin with, and patience to wait for it to materialize over years. These leaps gave Cornwall extreme leverage with a deadline generous enough that being early didn't automatically mean having to post last born. So when the Capital One stock recovered, 26,000 turned into 526,000, a 20-bagger, executed by 2 guys whose combined professional trading experience was no more than you or me. So the logical thing to do once you find one mispriced option payout is to go find more of them. And that's exactly what they did. Next up, United Pan-European Cable, a distressed cable company operating across Europe, which is possibly the least exciting sentence ever spoken on YouTube. Nobody on Wall Street wanted to spend a single afternoon reading about European cable debt restructuring, which is understandable, even for Wall Street. Jamie and Charlie though, armed with the power of autism and Adderall, spent several weeks doing DD, and I mean actual DD, not just doodling on a chart. Too bad Wall Street Bets wasn't around back then for them to post their DD and have some guy working at Wendy's call them regards. So long story short, they ended up YOLOing $500,000 into Leaps. The company clawed its way out of the gutter, and the position turned into $5.5 million. After that, and I promise I'm not making this up, they found a tiny company that delivered oxygen tanks to people's homes. 20,000 in, $3 million out. At no point in either of these trains did anyone at Cornwall have a Patagonia vest, a corner office, or a name that sounded like a law firm, if you know what I mean. By early 2006, the shit fund was sitting on $30 million. 3 years in, up almost 300-fold. So you might be asking yourself, how can I use this strategy to YOLO my money and make multi-baggers like they did? Let me show you how. Back in April 2025, Intel was trading around $18 a share. Its lowest price in over 15 years. Written off by pretty much everyone as a company that had permanently lost the plot. But you being the smart contrarian that you are, understood that Intel with its advanced chip technology will play a crucial role in the upcoming AI boom. So we go out and buy $5,000 worth of 2-year Leaps calls at a $20 strike instead of the stock itself. Fast forward to today, Intel has a new CEO, a $5 billion investment from Nvidia, the US government buying an actual 10% stake in the company, and Intel is trading north of $90 a share. That same $5,000 Leaps contract is now worth something like $75,000. So congratulations, you just 14x'd your money. And that is how you use Leaps to YOLO your money like Cornwall Capital. Now here's the problem with having $30 million to YOLO. And yes, I know what that sounds like. I wouldn't mind having that kind of problem, honestly. Bidding on mispriced options is great and all when you have a few $100,000, but once you reach a certain portfolio size, there aren't enough counterparties who are selling those options. So our friends at Cornwall Shed decided that it's time to trade derivatives like the big boys. Except you can't find the type of exotic derivatives they were looking for in the Robinhood account. So their first move was to call the big prime brokerages in New York to set up a big boy trading account with a big boy bank. The problem is, those banks are filled with pretentious douchebags, so they won't return your calls to set up a big boy account with what they consider chump change. Around this time, a Deutsche Bank trader named Greg Lipman is going door to door, pitching anyone who will listen on a genuinely wild thesis. The subprime mortgage market is a house of cards, and you can short the entire housing sector using something called credit default swaps. You've probably seen all of this anyway in The Big Short. And if you didn't, do yourself a favor and watch that movie. Also, if you haven't seen the movie, mad respect for watching a video about two random guys who made some money back in the day. But to trade the credit default swaps that were about to define the 2008 financial crisis, you needed an ISDA master agreement. See what I mean about pretentious Wall Street jargon? ISDA, credit default swaps, Leaps. Think of an ISDA as a nightclub's VIP pass. The banks don't really care about your performance or your bank balance. They care about pedigree, zip codes, and whether your firm's name sounds good on a pitch deck. And a credit default swap is just an insurance. You pay a premium for the privilege of getting a big payday if a certain default event happens. These derivatives are not available to you or me, unfortunately. And honestly, I think that's for the best. I can't even imagine what Control the Narrative would have been able to do with this kind of leverage. For years, Jamie and Charlie begged the big banks for an ISDA agreement, and for years, they were ghosted. Just like you when you try to slide into a baddie's DM. If you've seen The Big Short, you know that by this time Ben Hockett has joined the fund, or as they call him in the movie, Ben Rickett. Former Deutsche Bank derivatives trader, part-time doomsday prepper, yada yada, you know the story already. Ben had spent years in the street, Wall Street that is. So he had one asset Jamie and Charlie couldn't buy, street cred. He made a few calls, cashed in a career's worth of favors, and got Cornwall an ISDA agreement. And just like that, the two degenerates in a shed are suddenly authorized to trade the exact same instruments as the bigwigs. You can imagine they felt exactly how you did when you first got options trading approved in your Robinhood account. And just like their previous trades, they started doing their DD. Not the kind of DD you'll find on Wall Street bets. They did actual institutional level autistic DD. They read hundreds of pages of mortgage contracts nobody else could be bothered to look at. They talked to people in the industry and so on. Cornwall took it a step further than the other gay bears though. While guys like Burry and Eisman were shorting the junkiest, lowest rated mortgage bond securities, everyone already knew those were garbage by that time. So that made insuring against them expensive. But Cornwall targeted the AA rated MBS instead. Those bonds held fancy investment grade ratings that meant that they were considered bulletproof. And by the way, the current credit rating of the US government bonds is AA. This is how solid Wall Street thought those bonds were. And because nobody thought a AA bond could default, the credit default swap insurance on them was trading at dirt cheap. This is exactly the type of asymmetric risk they've been making so much money with, and this time is no different. So they end up buying $7.5 million in credit default swaps off of Lipman's desk. 4 days later, another $50 million from Bear Stearns. Unfortunately, predicting the crash wasn't the finish line. They still had to collect the cash. The problem is, the banks that sold them the insurance, including Bear Stearns, were holding the
biggest bag of odorous excrement ever assembled in the history of capitalism.
And this is where you know these guys are still just a couple of guys in a shed. They never once thought about counterparty risk. They just assumed that everything works fine since it's managed by the big pretentious institutions. If they had spent time working in the industry, they could have realized that part of the risk is counterparty risk, even if the counterparty is a 250-year-old prestigious bank. Over at his own fund, Michael Berry refused from day one to buy CDS from just one bank. He spread his bets across Deutsche Bank, Goldman Sachs, and others, specifically because he didn't trust any single counterparty to still be solvent by the time he needed to actually collect. Cornwall didn't do that. When they built their $205 million position, something like 70 to 80% of it went through one counterparty, Bear Stearns, and it was about to collapse. But luckily for them, they had Ben Hockett, who is a veteran of the game and a hell of a trader. And as you may have seen in The Big Short, they managed to sell all of their contracts from an old British pub with shitty Wi-Fi before Bear Stearns went bust. By the time the bar rang last call, the batch of insurance that had cost Cornwall roughly $1 million in premiums sold for $80 million. Depending on which audit you read, Cornwall walked away from the 2008 crash somewhere between $120 and $135 million richer. From a starting point of 110 grand in a backyard shed, that works out to roughly 1000x return in about 4 years. That's the kind of performance that gets you instantly banned from Wall Street bets for posting fake screenshots. What I want you to take away from this story is this. Everyone on Wall Street had access to the exact same public filings, the exact same bond prospectuses, and the exact same data Cornwall used to execute every one of their trades. Yet the institutions simply refused to read the fine print closely enough to realize the opportunity. A history major and a spreadsheet intern working out of a garden shed actually did their DD and made generational wealth, while everyone else in Wall Street was busy throwing around words like credit default swaps and ISDA. Here at Brown Hole Capital, we pay special homage to the OGs, the spiritual godfathers of this channel, doing autistic DD, taking asymmetric risks, and showing degenerates everywhere how it's done. So the next time your portfolio looks like a crime scene and you're wondering whether you should go long rope, I want you to remember the tale of Cornwall Capital.
And they keep calling this Brown Hole.